Welcome to the Diversity Project Pathway podcast. My name is Omotunde Lawal. I'm a PM at Barings. Through this podcast, we aim to delve into topics that could be of interest to our audience in the asset management industry, especially female investment professionals. We have lots of exciting topics and guests lined up, and today I'm delighted to be joined by Sonja Laud, and the topic we'll be discussing today is In Conversation with a CIO. Welcome, Sonja.
Thank you very much for having me. Good morning.
Thank you. So we like to kick off this podcast. It's a new podcast, so we'd like to kick it off with a fun fact. Can you tell our audience a fun fact about you that they may or may not know?
Some might know, but the fun fact is that I actually never aspired to be a CIO. I wanted to be a professional horse rider.
That's shocking. You didn't dream about being a CIO at the age of 5?
No, I didn't. I spent my time with horses and I loved it.
Oh, great. Do you still ride these days?
Occasionally. So it's not as straightforward as it was back in Germany. My daughter rides a bit as well. And actually, we've been just in the New Forest last weekend for a little riding excursion.
Ah, lovely, lovely. Yeah, it's very soothing. We did a bit of riding during COVID, but sadly, life has gotten busy again now, and that's fallen by the wayside. Right, so let's kick off with the conversation with a CIO. There aren't very many female CIOs, so we're extremely privileged to have you here today to share some words with us and with our audience. Maybe we could kick us off by asking about your journey on how you became a CIO. I noticed that you've worked at so many of the illustrious asset management companies, and you actually formerly worked at Barings. Previously, you've been at Fidelity, DWS, now you're at LGIM. Could you maybe tell us a little bit about your journey to get here?
Yeah, absolutely. So as I said, it was not my intention to end up in the asset management industry. And the way I got here really is a little bit of trial and error. So after school, when I think I started to realize that being a professional horse rider requires a lot of talent, but quite a lot of money as well. And then did what is very classic in Germany. I did an apprenticeship. So I joined Deutsche Bank. You know, it's a dual system. You go to school, but you work at the same time. And afterwards, I decided I was very clear I wanted to go to university. And after my first 1.5 years at Cologne University, I then went on to study abroad. And I spent 1 year in Paris, 1 year in Oxford, and 1 year in Berlin. And part of that program was you had to do an internship in every country. And so I actually went on to work in marketing, investment banking, asset management, and consulting. And what I loved about asset management actually was the intellectual stimulus. I always worked on a global level, and I loved the people I met. I loved the, engagement with global topics, macro, and of course then working with individual companies. And so the decision at the end was to join DWS in Frankfurt at the global equities desk and start as a fund manager. That was the other beauty of the asset management industry in Germany at the time, because they did not have the classic analyst and PM system. So I started as a fund manager.
Oh, wow.
And that was an amazing experience. I had a wonderful boss at the time. And so I had a really amazing start to my career and have been a fund manager for the largest part of my journey. And after 5 years at DWS, I got a very friendly call from Schroders here in the UK. And I think one element that becomes clear throughout my journey is this intention and the ambition for lifelong learning. Because the reason to come to the UK was the realization that, of course, the UK asset management industry was far more established, broader, and would have provided and actually did provide me with that learning. So I came over to join Schroders, which was another fabulous part of the journey, and continued to work as an active equities fund manager. And it was at some point towards the end of my journey with Schroders that I realized that I would want to do more and that I would like to be considered for managerial roles. So what I did then, and that probably is a classic female trait, is I started analyzing what skills I would need to be considered.
Right.
And of course, turns out if you have only done equities until then, there's the vast part of fixed income and asset allocation that you should at least be able to have a decent fundamental knowledge about. So I decided I would like to do an exec MBA, which I did. Okay. and then actually joined Barings in the multi-asset team.
The exec MBA was at the same time whilst you were working? It was a
half. So I did leave Schroders. I should say that I did apply for my exec MBA when I was still pregnant with my second child.
Oh, wow.
And
even more impressive.
And he was very young, so I took the opportunity to actually not work all throughout the exec MBA, although you're very right to call out these programs are designed to do them next to work. And then halfway through the program, I was able to join Barings in the multi-asset team, so was able to cover the fixed income part, the asset allocation. I did launch 2 funds with Barings, but as you well know, they did actually go through quite a lot of change at the time because of the merger. And I then had the opportunity to join Fidelity, and that was my first managerial role as head of equity. And again, yet another amazing company, which then led me joining LGIM as first deputy CIO, but only for a very short period of time, then to become CIO actually in mid-2019. And as I said right at the beginning, what I love about the industry is the amazing people you meet, the intellectual stimulus, and really the diversity of the subjects and the themes you're confronted with, which to this day is really the fascination. Of course, alongside using that knowledge to help clients meet their financial needs. So it's a great combination. I love the industry, and it's been a formidable journey.
That's been quite the scenic route as well. But through it, I think my main takeaway from that, as someone who aspires to that as well, is making sure that you're equipped with the building blocks of being a good CIO. So you started off in equities, and you sought out that experience in multi-asset, and you sought out that fixed income piece as well.
I mean, you know the classic saying, right? A man probably would not have done that, right?
That is
because
true.
they probably would have thought straight away. They are, of course, very capable, and that might well have been the case. But you see, at the end of the day, is really knowing yourself, taking time to reflect before you even come to the decision that you might want to do a managerial role. Is find out, why do you want to do this? What is it that you find so attractive? What's it that your passion is all about? And then really consider, am I confident enough to put myself forward? And if the answer is that you think you should have more skills in order to put yourself forward, that's okay. So I know we are always differentiating between male and so men and women, but at the end of the day, it's all about you.
It's about the individual. Yeah, 100% agree. Yes, I agree with that. And that's why, if you really want it, you shouldn't take no for an answer, and you should strive to make it happen. Thank you very much. We'll definitely come back to that, because I've definitely got a few more questions to ask you about this journey as a CIO. Would you mind sharing with us what your current outlook is over the next 12 to 24 months? In the aftermath of what the US elections is? I know it's been called the closest one we've ever had. And wherever the chips fall for that, what would be your outlook?
Yes, of course, it is the event. And I know that probably the podcast will be published well after the event, but it would be wrong not to mention it, because we're sitting here. Today is budget day in the UK. And of course, next week is the US election. And it is so important to put this in context in what we are currently seeing as the backdrop of the world, really. So we have the election in the US literally been at the end of a year where 50% of the global population has been going to the polls. And it would be wrong not to look back to see what have we learned actually, and will the US election be so different from what we have been seeing elsewhere. Now, the takeaways clearly have been that people are genuinely unhappy with current policies and with incumbent governments. So the idea of this backlash vote is very much alive. And we have been seeing very often this being expressed through a shift to the right. We are seeing immigration probably as the most emotive and global topic, which is and has to be addressed by all incoming or incumbent politicians. We have seen, of course, the cost of living crisis as a major topic. We have seen some local topics, but clearly these are areas where people are saying it doesn't really work for me now. I see my standards of living falling. I'm feeling threatened by what I see on the immigration front, and I want you, dear government, deal with it. Why is that so important? It is because, and this is why, of course, sitting here having budget day today, because it demonstrates the difficulty that governments will face in balancing these short-term needs, which, by the way, most will cost money, with the absolute necessity to invest in structural growth themes for the long term. Because we know that trend growth has been coming down. We know that population growth is verging towards zero. We know productivity growth has been very subpar. So these are very, very difficult choices. There is no easy answer. Taxes are coming back. Is it inevitable that taxes have to rise? And guess what? The themes are not that different in the US. Immigration is a big topic. We have, of course, abortion rights in the US. So there's a difference. So there's nuances with some of the very emotive local topics. Here in the UK, it's been the NHS, right? If you don't have access to medical care, you will be very loud and say, sorry, that doesn't work. But that is what has been so dominant in the political debate. And to me, the main takeaway for us as investors is there are no easy choices. And where fiscal policy will fall and what choices governments will make, that is where the market will take note. And this is all of what I've just said is even before we come to the geopolitical side, which of course will take an influence as well. Now, I'm very often asked, why are markets so sanguine? You know, we look at record highs in equity indices. We have close to historic tights in spreads. So you could think we're in a parallel universe because markets seem incredibly happy with what they're seeing. And that is so important for investors to take away, because what the market is pricing right now is what has been a very narrow consensus pathway all throughout 2024, which is we have a mild slowdown. Inflation will approach target, not necessarily in 24, but clearly in 25, and that allows central bank to cut rates. That's been the kind of Goldilocks scenario, so no hard landing, no recession, and of course inflation finally coming back. And that's been priced. But now the problem is any change to that narrative, of course, means that very high valuations are then met with an external shift in the narrative or potentially an external shock. So investors need to understand where potential asymmetry of risk returns will then unfold in the context of that shift. That's why the elections are so important. So let's stick with the US election. As you say, it's a coin toss. We don't know. What markets will be focusing on is actually the probability of a clean sweep, because that probably is the only narrative that has the potential to significantly shift the growth and inflation narrative. Again, that's the only thing the market will take note of, because it would then put pressure on the Fed in terms of their pathway.
The rate path.
The clean sweep, of course, as we know, is that all three, i.e. the White House, the Senate and the Congress, will go to one party. It's been very rare. We've mostly had split government for the past couple of years. And that is important because, of course, if one party dictates it all, the chances to push through reform or, of course, in what we are now talking about, fiscal policy, is far easier. Right. Now, interestingly, the Democrats and the Republicans actually are quite aligned when it comes to fiscal policy. Why do I mention it so much? Because we're still end of cycle. If you continue to stimulate an economy that already is at the end of the cycle, the textbook tells you it's inflationary. Correct. And that, of course, currently is not priced. So this has been really, really interesting. And, of course, that means as well, you have to wait for these events to unfold before you can start considering what the next 12 months look like. And as such, it's been really short term. We've been seeing a market reaction function that's very much focusing on the most recent data point. And we've actually seen an increase in the magnitude of how markets react. And I would imagine once we're through budget today, once we're through the election, at least you're giving the market a chance to start looking through what it might look like.
I think that sounds very much in keeping with what we hear as general consensus as well, is that everyone thinks it's too close to call right now, and so everyone's sort of staying very neutral going into this. And you're very right to say what really matters is whether it's a clean sweep or not, and that dictates the magnitude of the inflationary pressures potentially.
There will be a lot of noise and volatility. Can you trade this? I don't think it's
Probably
really worth
unlikely,
it.
yeah.
No, it is really difficult to trade it. And we know if you go back in history, it normally is not worth trying to capture it, because given that it is so close, we know there's differences between the so-called Trump trade and Harris trade. Do you want to put it on one way in terms of betting? I don't think this makes a lot of sense.
So certainly not as fiduciaries as well.
No.
And maybe that brings me to the next question of how, is there a perspective you could share from asset owners that you're speaking to in terms of how they view the future as well, 12 months out from here?
So it's been very clear that asset owners have been looking at the potential risks they're carrying, right? Given that the journey has been actually quite a positive one in terms of returns across risk assets, it's more about, okay, if we were to see a shift in the narrative, how can I make sure that I can reach a level of diversification that potential drawdowns are not that impactful? So how can I cushion the potential downside? And we all know that hedging is very difficult if you have, such uncertainty around the pathway forwards. And we can come to geopolitics and tail risks in a minute, because it's impossible to forecast. So we would advocate far more, and this is what we're working with clients on, how can you look for uncorrelated revenue streams, and how can you look for natural diversification buffers. Now, we all have been through the very painful experience in 22 where your diversification, particularly with government bonds and equities, didn't work, right? Because we all of a sudden had a positive correlation. And so that was very, very difficult, because within a multi-asset context, there was very, very little that allowed you to naturally diversify the swings of the market. Now we have seen a shift now, because it's clear in 2022 it was the inflation narrative that drove markets, which of course has a very different context to when growth is the dominating market narrative. Right. As long as it is growth, you will always see government bonds working as your diversification benefit, and they will provide you with that cushion. Now that has been the case throughout 24. It's been quite volatile. So we have been actively looking at duration as a measure to add value to portfolios. But in an overall 24 months or 12-month scenario, we would still think that the cutting cycle is underway. There's different opportunity sets. So right now we believe there's more opportunity, for example, in UK gilts, because they've been the laggard if you look at the developments. But again, this is not a one-fits-all, because we are seeing different dimensions in different markets. But duration in general, so long government bonds, should provide you with that hedging benefit that we think will help you through a very difficult period, potentially, if we were to see, let's say, a meaningful shift in fiscal policy again in the US, which clearly would increase the worry around inflation and central bank policy in the US.
Right. So that speaks more to a higher allocation to fixed income versus equities at the moment, is my takeaway from that.
Yeah, I think most would probably be more neutral risk. And of course, then it depends on who you talk to, because the risk appetite is very, very different. If you're a pension fund here in the UK, your risk appetite and positioning will be very different to an asset owner potentially overseas or in Asia, where the trajectory and the expectation are very different. So it really depends. But the common denominator is really this understanding on how you achieve a risk-return profile that would be commensurate with potentially far higher volatility, particularly to the downside.
All right, great. Now, whilst I've got you, I'm going to sneak in a question on AI because it would be remiss of me not to sneak that in. Now, in your role and in your capacity of someone who works closely with the IA, works closely with others in the industry, and obviously very experienced in the asset management industry, what is your view on how AI will change our industry and the impact it's going to have on us as asset managers and custodians of these assets for the next generation?
I believe AI will be an inevitable topic that asset managers will need to look at in order to understand how it can influence and help efficiency across the asset management industry. The reality for the industry currently is that fee pressure is ongoing. The cost of doing business is going up, and client demands are shifting towards more customization, more sophistication, and of course with the level of investment excellence that they would see as a necessary ingredient in achieving their objectives. That means as the asset management industry, your productivity has to go up. And you can look hence across your investment platform, you can look at the investment processes, and that's where AI comes in. You need to enhance productivity per fund manager, per head, and that's true across analysts and fund managers. Most obviously, that means more funds per head. So you need to come to an efficiency level across your platform that allows the fund manager to do this. And that whilst the customization level per client goes up. It means as well that, whereas this is probably more a technology and automation question, it is then, of course, in terms of the content, how can you enhance the output per head? And this is where I believe AI can help. AI can definitely help if you consider the research process. A lot of what currently is done by humans in terms of, the balance sheet analysis, the annual report, the facts
the
and
note
figures.
taking from conferences,
Absolutely.
the earnings calls.
Can be supported and enhanced by AI, which means you can increase coverage per analyst. You can enhance and, accelerate the output. And then, of course, you can use AI for the interpretation as well. You still want the human to do the engagement, to do, of course, the understanding analysis of the forward-looking. You need the human to understand particular sustainability-related matters and facts. And so you can see that you have to be very clear in defining the value add of the human, but where AI can really enhance not only the output, i.e. the productivity, but the content and the accuracy of the analysis as well. And then you can move a step forward. So that's on the analytical side, i.e. the input factors to the investment process. But then inevitably you're going to look at the portfolio construction process, where clearly, again, if you want to look at the way we're currently constructing portfolios under risk-return considerations, surely AI, again, can help make it faster, more efficient, and can enhance the outcome so that then the alpha generation really is sitting on top of a very balanced, risk-adjusted portfolio construction process that at the end of the day delivers a better outcome for clients. That's the most obvious areas on the investment side. Then, of course, you go to RFP processes, client queries, everything where clearly we are currently employing a lot of humans. And again, for the time being, I'm talking about enhancing processes, accelerate them, make them better in terms of the content, the output. You will always need someone to check and validate the inputs that have been provided.
So certainly game changing, and perhaps even from an asset owner's perspective as well, thinking about how they would use AI in manager selection as well, running
Absolutely.
their search processes as well. It's just going to permeate all parts of our industry, and it's definitely probably the biggest bang in our industry. Do you think that brings additional fee pressure on top of the existing fee pressure?
There's a lot of fee pressure already been ongoing. So you wonder whether there is at least a new equilibrium we can reach, because of course with the level of customization and sophistication, there has to be a balance that at the end of the day, if we can deliver the outcome the client requests after fees, then there has to be a greater openness on fee levels. And value for money should not just be expressed in basis points, but should be expressed in the overall proposition that is put forward. Because we are always looking at performance and the delivery of that after fees. So if that's commensurate with the target and the objectives, that there should be more room to define value for money. Now, is it going to reverse? No, I don't think so. But I think at least there will be a stabilization, and which means alongside everything I said around enhancing productivity per head, you will have a better mix. But what is interesting is that the AI conversation is really put against a backdrop that is increasingly challenging. We have to assume that asset managers find themselves increasingly under pressure because the dynamics are there for everyone to see. So you need to really get on the front foot in order to put the right measures and investments in place to make it work.
All right. Now I'm going to go to maybe a little bit more of the people part of your role now. In your role, you sort of have a huge team reporting into you, and you sit in the senior leadership within LGIM. What qualities, for our listeners, what qualities do you look for when building and leading these high-performing investment teams? What should our listeners be striving to become?
Authenticity, energy, passion, honesty, and the willingness really to engage. And we are, because what I'm looking for is high-performing teams have to be built on trust. And this is why all the characteristics I've just mentioned are key ingredients to get there. And, it's trust requires time to be built. Trust requires you to spend time with your team members outside the office, because you will not be able to get to know them if you're sitting in a meeting room in the office.
Absolutely.
But the transformation that you will be able to achieve with this is just fabulous. We're looking for cognitive diversity, and you will only really be able to harness this if people are feeling safe to contribute what they really think.
Yeah, that psychological safety is very key.
Absolutely.
To extracting optimum performance from the teams.
Yeah.
Yes, I find myself with my team as well is making sure I'm trying to foster an environment where they feel psychologically safe in our investment committees, in our team sort of dialogue, to come up with what comes through to them.
Otherwise, you will have a consensus-driven outcome, which in today's world can never be the right. If you don't have diverse views, for example, on duration, interest rate pathways, the outcome of the election, the fiscal sustainability argument, because there's no black or white answers. And so you need to bring in people that will look at a problem differently. And by the way, this does not only apply to the investment decision-making process. This applies to the company context as well. What you want to get to is that you're taking decisions on a risk-adjusted basis that will end up being better, because the risk point of views are just far more diverse, which will allow you to take decisions that will, at the end of the day, have a higher return. That's the concept behind it. Yeah. And this is why this diversity aspect is so key. But I always aim to move away from the gender or ethnic minority point, because cognitive diversity, yes, will very often come with it. But if we can focus on that's where we want to get to, because that's what drives the benefit, it might feel more inclusive, because it really focuses on your capability rather than
individual.
Absolutely.
Yes, absolutely. I couldn't agree more. Right. So maybe we'll sort of could I take it to a slightly different angle as well? What advice would you give to aspiring investment professionals as we sort of round up and coming back to your role as someone who's a leading female CIO in our industry? What advice would you give to aspiring investment professionals listening to this who are aiming for leadership roles, such as your one?
Most importantly, and I mentioned it before, is authenticity. Do not try and be somebody else. Do not try and copy what you see as potentially winning behavior somewhere else. Because at the end of the day, your success will very much depend whether you're feeling yourself and whether you're feeling happy in what you're seeing in yourself. The reason why I stress this so much is it will need time to reflect. This is not it took me a long time. I'm 50 now, and I've had coaching ever since 2012, really on a regular basis. You need to understand yourself and who you are, because, the more senior you are, the more you work with stakeholders. Stakeholders require careful listening, careful engagement. And it helped me a lot to understand what triggers me. You will always find situations that you're irritated, you're annoyed. So for me, very clearly, having been a fund manager, you're paid to process information very fast. You're paid to take decisions on probably 80% of the information. So these are character traits that, of course, mean that they help you a lot in terms of your decision-making, strategic vision, and the like. Not all stakeholders will be in the same, operate in the same way. So, very often I think, oh my God, this is so blindingly obviously. How on earth can the others are not there yet?
You have to control yourself to say, isn't this obvious?
And that's the point. And this is a learning to understand, why do you react this way? How can you help yourself just to relax and help others to get to the same viewpoint? It's not always straightforward, but it's such a rewarding process to spend time with yourself, because I genuinely believe the more you understand yourself, the more you like what you see in the way you are operating and engaging, the easier it is to really move forward. But it takes a lot of time, because very often you will find out that your own personal trigger points date way back to your childhood. But they're so important to analyze, because what is the reality is trigger points you will never be able to change. The only thing you can change is your own reaction function. What it helps you as well is looking at others differently. You will allow yourself to try and understand, why are they reacting annoyed, irritated, angry, because it is the same process for them. We all have our needs, and if you start from that angle, like, we are all equal and we all will have our own needs and viewpoints. And I've more recently looked at something called perceptual intelligence. If you can allow yourself to change your point of view, it will influence your emotional reaction and it will influence your actions. It's a very simple but so powerful understanding, and this is why that is my key advice, because if you are happy with yourself and you have a clear view on where you want to get to, it will drive your passion, your energy. You will be convincing, you will come into interviews because you know what you want. And then, of course, you will have that journey that I outlined earlier. Whether you then think you need more skills, just go for it, because it will give you the confidence then to come to an interview and say, yes, I can.
All right. So I'm going to round up. For those who aspire to be future CIOs, you've got to dream it. You've got to believe in yourself. You've got to do the homework on yourself to understand your trigger points, understand what it is that you're lacking in the skill set, and go out and get it. And then try to put yourself in others' shoes every now and then, and just stay eternally curious and hungry to learn. Thank you very much, Sonja, for being with us today. We really enjoy this conversation, and we hope to see more of you in the future. Thank you.
Absolutely. Thank you very much.